Today's lecture is going to be focused on whole life insurance. Whole life, of course, comes into two different forms. You've got your non-participating, which is what we're going to talk about now, and we'll talk about participating later. But basically, whole life, first of all, is a permanent insurance. In other words, you are going to be insured for the rest of your life. And because it's permanent, basically, your coverage never actually runs out. Unlike term insurance, which, as you know, will terminate at a certain point, this simply goes on for the rest of your life. Now, as the name whole life basically suggests, okay, you're going to be paying a premium for the rest of your life. So when you're buying a whole life policy, if your premium is $2,000 a year, it will be $2,000 a year forever and a day. So basically, well, essentially up to age 100, usually insurance companies will stop making those payments at age 100. But for all intents and purposes, you are going to be paying a premium basically for forever and a day. So for those consumers that are saying, I don't want to go off and pay a premium, let's say beyond age 65 or age 70, is there another option? The answer is yes. You have what's called a limited pay life. In a limited pay life, what basically happens is that you are really paying, let's say, to age 65. At age 65, it actually terminates at that point. You're still going to be insured for the rest of your life because, remember, it is permanent. It is whole life. All you're really saying is that I don't want to pay for the rest of my life. I only want to pay to age 65. So therefore, they're limiting the actual payments. So obviously, the premium for the limited pay life is going to be much higher than for the whole life because here you're spreading out that payment forever and a day, whereas on limited pay life, you're basically saying, I only want to pay for 20 years, 30 years, 40 years, whatever the case may be, and that's it. So essentially what happens is that the insurance company will increase the premium because you are crunching the time. And the reason why they can do that is because we have what's called a policy reserve. That policy reserve basically is commonly known also as your cash surrender value. So in permanent insurance, you've got a combination of your insurance coverage, but you've also got the cash surrender money sitting in there. It's that buildup of the cash surrender that actually allows us to sell to your clients a limited pay life because you're paying more premium. It increases the amount of cash that's actually sitting in there. So therefore, when the person stops making those payments, the insurance company simply go in and take out the money from the cash reserve and continue on the coverage for the rest of your life.